Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I interview founders, entrepreneurs, executives, thought leaders, amazing people, guests from all over the world in crypto and blockchain. And today I have an amazing guest coming to us from the country to the north. I'm in the US, he's in Canada. I welcome the CEO of CoinChange, Max Galash. Max, welcome to the show.
Thanks, Jamil, for having me. Appreciate it.
You're very welcome. So let's kick things off, and let me ask you first. What's your background, and is it a logical background for what you're doing now?
I think logical background is overrated. Uh, I I'm originally from Belarus. I'm born there, but I've been in Canada for the last 25 years. I did my electrical and computer engineering degree here at the University of Toronto. Since then, I had a software development agency that's still around called ITM. It's been almost 15 years right now that it serves a different type of clients. I still sit on the board and collect my dividends, do my duty on the board, but not active on the operational level. I had a venture fund called BGS Ventures. It was a pre-seed $10 million fund out of Cayman. And we ran it for about 4 years in 2011 to 2015. After that, I transitioned towards the entrepreneurship myself. So came back to the service agency and we started building various type of startups and products and taking them to market. So I sold one, I had one exit and a couple of them did fail. And as my latest venture is CoinChange. We've been doing it for about 4 years right now. Started in 2020 as an idea and took it to market summer 2021. We've been servicing clients for the last 3 years. And in 2 weeks, it's going to be 3 years in the market. So that's pretty much my journey. I don't know how well am I set up for crypto business, but I've been buying Bitcoin and Ether since 2017. I do hold some other tokens as well, not investment advice. But yeah, I've been buying for a while, for probably the last 7 years, and I've been building in crypto for the last 4 years. So, and the engineering background helps.
Yeah, sounds good. Yeah. I won't give investment advice either, but everything on my screen is red today. So, I know.
You know the ups and downs of crypto, right?
That's right. That's
There's
right.
still bulls to be in the industry these days. Going from 16 to 60, right?
Yeah.
Everywhere in between. So
Yeah. So CoinChange, right? What's it all about? How do you
Sorry, Jamil.
I said, how do you revolutionize digital currency exchanging?
No, it's a little bit more than that. We're not really focused on exchange business. CoinChange started initially as a competitor to Celsius, BlockFi, Voyager, and many, many other famous names that we still love or hate, mostly hate, I guess. For the last 2 years, there was a lot of trauma to the market, right? Because of a lot of those bankruptcies. But we did a competitor to Celsius, pretty much building a brokerage business, licensed brokerage business. When you can have your custody of your assets on the platform, you can swap between different crypto assets and you can have a fiat accounts. So move money in and out through your banking system to purchase like an on and off ramp into the crypto world. We did have an earn account. So earn account was not a lending business. We didn't participate in any of the lending activity that was very, very popular those days. We built up our own yield farming strategies. So everything on chain, smart contract driven and data driven. It was pretty simple at the very early days. So in 2020, when we started building that, it was pretty much a smart order router to find the better pools to allocate the liquidity. Obviously, in the last 4 years, the system has really enhanced. Right now, it has quantitative systematic ways to find yield, to use restaking, using liquid lending, using concentrated liquidity provisioning, and all types of native blockchain mechanics to generate rewards and returns on participation in those different decentralized applications. So more than that, I mean, this is the earn business. That's a core of our platform, but we do have a gift card offering business as well. we do have an on and off-ramp business, and all those three products are offered under CoinChange umbrella directly to business customers, as well as the white label to our distributors, B2B2C customers that embed those products into their apps and allow their end clients to do those, to have those features available. So more like a B2B platform, as well as the infrastructure play as an extension to that.
Competitor to Celsius.
Yeah, but it's changed since then. I mean, that was like after FTX, we did a hard pivot towards the infrastructure. So if you're gonna go to the CoinChange website right now, you'll see everything about the APIs, sandbox, integration guides. So we work with fintechs, right? We work with wallets, exchanges, neobanks, and payment providers, so they can integrate, let's say, our Earn account into their application. So if they hold any stable coins, their clients, their end clients, will be able to tap in and earn on those deposits. So we don't really face the client directly. We'll face it through a wallet. That's our partner. We'll face it through an exchange. That's our partner. We'll face it through a payment platform. That's our partner, right? So we work with the businesses. They can have a direct business account with us and use their balance sheet to earn or do the trades on and off ramp, or use the gift cards. But they can also integrate all those products into their application to offer to their end clients. And everything is revenue share driven. So we don't charge them for the products. They earn with us. So we call it not sales, but partnerships.
Got it. So that's why you're still standing in Celsius, BlockFi, and others are not, because it did it directly.
Yeah, we didn't really participate in lending. I think the major problem was the shadow banking component, when they lended the client assets from their balance sheet to traders, miners, and whoever else, right? And obviously not a lot of controls, and the very high speed market, and yeah, the flash crashes and everything will liquidate a lot of those positions. So definitely a trickle down effect, right? We never participated in that. We only used yield farming mechanics. And yield farming decentralized world was stable. Even when FTX happened, a lot of liquidity was exiting the market through DEXs. So, and it's proven even more to be more rigid right now with the restaking and obviously liquid staking like Lido.
Yeah, I want to get into that staking, restaking, liquids. I want to find out how you guys optimize DeFi aggregation and make it friendly, because I'm telling you, I used to go into the yield farming chat rooms, and like it was like I was looking at hieroglyphics.
Yeah, it's another world. I mean, it's that's kind of a big question, right? How do you make DeFi accessible to all? How do you really decentralize and make products very user friendly? And I think the combination of CeFi and DeFi will solve that. So like we're a CDeFi player, so we do have custody of your assets, right? When you deposit into our system, but we use DeFi mechanics to generate yield. And for our partners, let's say exchanges, they see it through everything. So they have the full visibility on chain onto their assets, but they have very limited control. So it's not a protocol. They cannot pull the assets out, and they cannot deposit directly. It happens through an aggregated basis, pooled basis with our operations team, but they see it through all their assets. They can have a separately managed vault, specifically private vault dedicated for them, where they see all the assets and all the funds flow, where the money is, which pools are used, which tokens they hold, which staking or restaking or lending protocols are involved. They can track through all the funds, and they can have all the balances visible to them. So that makes a big difference, because there's a lot of trust, because they can see everything on chain. Even though they can't control, they still have a counterparty risk. With us, they can't control those assets, but they can at least validate for themselves whatever been told. And so it's kind of a big difference.
I like that word you used. I use it all the time. It's called vault.
Yeah, vault. Yeah.
A lot of they are not using a vault. They're actually holding a position for a few seconds and trading them and memes. And sometimes they make money and a lot of them lose. I call it volatility, but what are the benefits people should know about using vaults?
For my perspective, Volt is a combination of different strategies. So think about it as a portfolio. Volt is a portfolio, right? And strategy is something that will utilize the assets to generate certain returns. Can be lending, borrowing sequence, let's say on Aave. Can be concentrated liquidity provisioning and Uniswap. Can be staking and restaking. Can be flash loans. So there's different strategies, and those strategies can be either executed manually by a trader or can be executed programmatically by a smart contract. Ours are executed programmatically by the smart contracts based on the data signals. So data is signals, pretty much. Data is signals are based on math, right? And data is something that you get from the nodes directly and analyze, or a third-party vendor like Dune, and analyze that data, aggregate it, and provide a signal to the smart contract to execute. So our execution is cross-chain, so chain agnostic. It's across many, many protocols, and it has automated risk management on top of that. Yeah. So when you can win down the positions, you can exit the position when it's required. You can full stop the strategy. So Volt is a combination of those strategies, and some of them work independently, as some of them are interdependent. So one strategy can depend on the other. So it's a way to have a unified access to a certain reward system through one Volt. You don't really have to jump through all the hoops yourself. It gives you the unified access to certain reward systems. So that's it. Very simple.
Sounds good though.
Everything sounds good and looks good on paper, right? You
Yeah.
should try it before you know it.
What doesn't look good on paper is I don't know if you what year did you come into crypto?
2017.
17. Okay. I was trading in 2019, and during that summer, I don't know if people remember this or not, a lot of liquidity dried up. So, and when liquidity in crypto dries up, it goes to zero and then it doesn't come back, right?
Yeah.
Some of that's driven by slow market, and sometimes it's driven by highly volatile inflation. I think you make it so that people can earn despite different, despite dry liquidity or highly volatile inflation. Why is the down market not the death knell that it used to be?
Listen, I'll address your question from from another angle. We work primarily solely on the emerging markets right now. That's where the need is for stablecoin, let's say stablecoin yield products. So people have a lot of stablecoins. People don't trust their government, their banks. They don't want to preserve value in their local currency, so they stack up stablecoins. You quite often don't even have an access to a USD account in a bank in most of those, in quite a lot of those jurisdictions. So they'll buy Tether primarily in the emerging markets. USDC is not really yet that popular. So, and then they'll look for ways to generate some dividends, some returns on that preserved value, because usually Tether is either used for international payments, Brazil, China, Argentina, Dubai, you name it, or to preserve value on your balance sheet or on your family. So we work, again, with wallets, exchanges, payment service providers to give them an ability to offer an earned product to their end clients. And this is all emerging markets. So we're in Eastern Europe, we are in North Africa, we are in Asia, we are in Latam, a lot in Latam, because there's a need, right? There's a need for earning some dividends and returns on a daily basis, principal protected through Tether or USDC staking. Not staking, but call it yield farming staking. Whatever the easiest terminology is based on jurisdiction. Again, I mean, it also changes, by the way, how they call it. Some of them just call it earn, some of them call it yield farming vault. Some of them will name it as a daily variable interest account, depending on the jurisdiction and the licensing that the partner has. They can have different naming conventions for the same product that we offer. But at the essence of that, as you know, it's yield farming strategies on chain. So the emerging markets is a big play. There's a clear need. I think in the US, first of all, you cannot offer any of the yield farming products right now because the SEC, there's no way to register or to get accreditation. The only option is to offer it through a fund structure, right? So, and to institutional type of investors. That's not something that we do. Even though we have a fund management business as well out of Gibraltar called Block Capital, but this is a separate conversation. We're primarily focusing as a SaaS business. We're focusing on the emerging markets, fintechs, and their end retail clients. So in the fund, you cannot service any end retail clients. In the US, I don't think there's a much, or in Canada or in the Western world, there's not much of a need to have our product because there's not, I don't think there's enough upside because we try to keep those portfolios fully liquid and with no market risk. So the average return on stablecoins right now will be around 11, 12%, while, a good dividend stock can pay you 8, or a good real estate mortgage can give you 10, fund 12. So there's not really a risk return profile to participate in any DeFi products for a retail client or institutional even client, I would say, in the Canada, US, Western world market. While in the emerging markets, the retail don't have access to that type of offerings in the USD denominated products, and their local currency is highly inflationary, and they don't have access to the banks. They don't have access to the USD accounts in the banks or USD investment products in the banks quite often. So that's, I think, a decisive factor for us, at least, choosing SMBs, so long tail clients, emerging markets, for the earned product. And we have a gift card product, as I mentioned, so that will enable, when Wallet will integrate our gift card aggregation product, they'll enable their end clients to buy gift cards for crypto globally. So if you are a Ledger client, Cake Wallet client, you will be able to off-ramp your Solana into a Walmart gift card with no KYC. Because gift cards don't require any KYC. It's a privacy-first product. You can buy it at the gas station without showing your ID. So there's a global off-ramp. The major value proposition on that product is minimal to no KYC, right? Very, very simple payment mechanics. So it's pretty much like a gift card payout. I can send it to you as well, buying it from my Cake wallet. I can send it to you, right? And Jamil will get it linked by email and put it on his Apple Pay and can use it anywhere. Let's say Walmart, Starbucks, or Visa voucher, because there's also Visa gift cards, are accepted. So that product will also offer to wallets, exchanges, and payment providers, but there's a different angle to that. It's not generating returns on your idle assets like stablecoins and Ethereum, but it is for payouts and off-ramp your crypto in a privacy-first environment to yourself or to a third party by an emailing the link, right? And all mechanics is integrated, again, through an API, a very simple, fast integration, without them necessary to build up all those connectivity to the issuing banks, for Visa, to the aggregators, to the Walmart and Starbucks of the world. There's 3,000 brands. So that's another product that we take to the emerging markets as well, and to the same ICPs that we have.
I've interviewed hundreds of people, and most people are focused on the on-ramps. And you just created a way for massive off-ramp.
Yeah.
What's the? I'm just starting to think of the potential. I think the potential is astronomical, right? What are the opportunities that are going to derive from that, and how is that going to help make rewards points, which was supposed to be an easy, the one which hasn't been so far, a viable next $1 trillion business in crypto?
I'll touch upon again from another angle a little bit. We do have an on-ramp business as well, because we have some authorizations in the US. We are able to get the direct banking relationships, and we can facilitate on and off ramp through direct banking rails that we have. That's offered directly to business clients through our CoinChange application, so they can have a USD account, fund it, buy Bitcoin, transfer it, fund USD through a Swift or ACH into a CoinChange account, buy Tether or USDC and transfer it. And there's also off ramps. The same matter, we have SEPA in Europe, we have Swift globally, and we have ACH in US. Those features are as well right now been available through an API. So for any fintech, like a wallet, exchange, or a payment provider, to integrate into their ecosystem as well. So it's not only gift cards, it's not only earned product, it's also on and off ramp business product that we have. How does the I think Ethereum is a great ecosystem. There's a lot of innovation. I bet long term on Ether. It's like a new AWS of the world. You know, a lot of people are building on top of that and using the stack and SDKs. There's a lot of cool L2s that are coming up, and definitely EVM is kind of the major holder of all the value, a big value of the ecosystem. I think Bitcoin is trying to catch up. There's a lot of innovation happening right now. A lot of money been put in as well in the L2s. They're building like Bitcoin restaking, Bitcoin payments, Bitcoin. I mean, obviously everybody knows Lightning. Bitcoin is trying to reinvent itself from the store of value to more of the as well server infrastructure and the ecosystem of the developer first environment. So I think it's great for both. You know, I don't really. I'm not the one that has a hard line. I hold both and I like both. But we at the DeFi side of our earn business, we only built on the EVM compatibles blockchains right now. So we don't touch, let's say, Bitcoin blockchain, or even Ton blockchain that's also pretty popular right now, Telegram blockchain.
It is. It's like the top in the top somewhere around the world. Ton is like in the top five of uses. So yeah, I don't use it. I use Telegram, but not a lot. But you said a few interesting things there. You said that some things are being built on Bitcoin, like the staking, restaking on Bitcoin. I want to find out what's been the effect on Bit of on the miners of Bitcoin's latest halving. And what do you think this impact will cause downstream to aggregation of various DeFi layers and protocols that are not built on Bitcoin?
Yeah, I think Bitcoin halving has two major effects. So first of all, it's miners are starting to look for a cheaper energy source and for a more efficient equipment. So that's number one. Number two, I think they're starting to look for secondary ways to generate yield and returns on the Bitcoin that they have on their balance sheet. So this is the Bitcoin yield farming and Bitcoin layer twos that have been right now coming up to market. So I think they're going to have an influx of the liquidity because the miners are forced to look for an extra income to keep their P&L intact, you know. So because of the halving, I think that's it. That's the major two. So cheaper source of energy, more efficient equipment, and extra income on their balance sheet to replicate their Bitcoin and find the native way to generate more returns to keep the same margins of the business.
Got it. So let's talk about investing in DeFi then. So popular terms recently have been restaking, liquid staking, pooled staking. What are those, and how are they risk reducers when investing in DeFi?
So I'll keep it short. I think pooling the assets is like it acts like an insurance, right? For the losses. It socializes the losses for all the depositors. That's what pooling does. And this is pretty much the model that LRT and restaking platform like Eigenlayer are going for. I think capital efficiency is the big one as well, because it benefits all the depositors, regardless of the capital they have, right? So the capital efficiency is in place. I mean, you have a small deposit or a super large deposit, you guys are benefiting in the same manner, in the same way. Cost efficiency. So cost efficiency when there's rebalancing operations, right? So you are not going to pay more than the other staker that has way more assets on the platform. So again, it's insurance, socializing the losses for all the depositors, capital efficiency, and cost efficiency, in my opinion.
Interesting. There's been that socializing the losses has come under fire recently. I think a lot of the ways that I've seen a lot of the ways that projects do it, others claim that it's because they issue more tokens and dilute their platforms, and hence have more people in the ecosystem. But that's a down I think negative part of some of these projects that are built on Ethereum. What do you see as the when you're the importance of a cap on these cryptos, and the important and what are the benefits of these projects, issuing more tokens to dilute their holders and socialize those losses, because it seems like a lot of these projects are dumping on their holders.
Yeah, listen, I think it's a well-known phenomenon, right? The pump and dump, and have the excess liquidity in place, and inflating the token price, and the deflationary effects of burning. I mean, I think it's all kind of a known facts. I think also what's important to consider is the risks that are associated with that, right? So loss of capital due to poor operational management, let's say, of the DeFi investments or DeFi protocols, right? They still have an operational procedures, like let's say Solon Finance got hacked because they didn't seed their pools. That was probably 3 months ago. And there's many other examples when they just meet the operational procedure that's well known as well and well documented, and just operational management doesn't take the procedure seriously or just forgets about it. Then the second one is the team. The team is known, or you don't want to have a rug pull. I mean, there are less and less kind of a phenomena because there's more transparency to the DeFi right now, but there's still quite a lot of anonymity, right, on the founder side for different protocols. Yeah, so I think little portfolio, like small protocols, they will run into capital dilution or capital inefficiency, right? The protocols that are small, they're going to die out, and the big ones are going to consolidate more of the market liquidity. Yeah, protocols that have a higher risk, higher level of leverage, will probably have a higher risk and volatility, right? So it will impact the strategies that are differently manually managed. So I don't know, Athena, it's a kind of a hedge fund on chain. For me, there's risk, and definitely ticks a lot of boxes. So I think risks are very important to consider when you're participating in the DeFi ecosystem. Not only the tokenomics and the inflationary, deflationary effects of that, but also the risks behind the protocol itself.
I want to thank you very much for your time today. I enjoyed speaking with you, and I have one last question.
Yeah,
and that's
Jamil,
how can
thanks a
people
lot.
find out more about you? How can they find more information about you, about CoinChange? How can they do that?
Yeah, I think it's easier to find. I mean, you can go on X. X is X Twitter. Find me there. It's Max G. Max G. My name is there, Max Galash. So it's just my handle, Max Galash. You can find me there. You can go on CoinChange and just email, or you can just text me on Telegram. It's MaxG86. Feel free to reach out at any point of time. Follow me on Twitter, and yeah, would be a pleasure coming to your pod again. Thanks a lot.
Awesome. Thank you very much for your time today.
Appreciate it. Have a good one. Cheers.